in the San Francisco Bay Area. Good evening, everybody. Welcome. This is the Thursday evening Viper Trading webinar. If you're here to learn about trading the futures markets using the Viper tools, you're absolutely in the right place. Tonight's topic is done in an hour or less. And so we're going to focus in early morning trading to see how we can capitalize on good movement on various instruments so that we can make the coin, lock it down, get on with our day. Got to go ahead and knock out the standard disclaimer first here. All communications from Viper Trading Systems are for educational purposes only. Futures and Forex trading does involve risk, and there is a risk of loss. Nothing contained in this webinar and other webinars, including the live trading room, are to be construed as investment or trading advice. And of course, everybody in here does know that you do trade at your own sole discretion. Okay. All right, well, if there's no questions on this, let's get straight away over to some charts, which of course is why everybody is here tonight. And let's get straight away over to screen one. Now, due to some data issues, I'm going to have limited availability on what I can show, but what I'm showing in terms of the price action and how we trade it is going to be applicable to pretty much any instrument that you want to trade. Okay, and so here's what I want to start with this evening is we have a NASI chart up here, and this is going back a few days, so this is not today, just to let you know. This is going back a few days. And the open of the market, 6:30 Pacific. So let's go back before we get into the open. Let's talk about what's going on with NASDAQ here. For those of you who are early birds or you trade the early morning session, you can see that over here to the left, you were pretty much in kind of a little trading range here. Took the bottom of it out, dipped down, came back up, got a higher low, went up, got sort of a little double top up here. This is about 4 o'clock in the morning Pacific time, 7 Eastern. We get a little consolidation patch right here around the midband, and then right around 5:20, 5:15 Pacific time, she starts to sell off. Now on this particular day, there could have been some news here. You know, somewhere along this 5:30 time frame, because you get, looks like a little bit of a shotgunning action here. She get a nice thrust down, background changes to red, comes back up, checks, comes under just shy of the midband. Let me take these predictor ovals off of here. There, that's a little, you know, that's what you can do with these. You can toggle them on. You know, you can see the swings. They're real good for that. See, you know, your swing levels. And then, you know, if you find it a little too busy while you're actually trading, you're just toggling those puppies back off. Yeah, so anyway, so we go very clearly into a downtrending move here. We get this retrace. You could have shorted this roll up here. Of course, if you missed that, you could have shorted this roll over here. There were a couple of places to get in the short. So the point being, the reason I'm even bringing that up is that if you trade the pre-market, there are opportunities where you could be up. You could be up. Let's look at these two trades real quick. You can put a couple contracts on here and actually made pretty good coin in the pre-market. Now the thing to be aware of, you really have to look at two things if you're going to trade just ahead of the open on the equities or crude or whatever you're looking at, or currencies after hours, whatever you're trading. You want to look at the spread. Everybody know what the spread is? When somebody says look at the spread on that instrument, does anybody not know what that is? What the spread is? When I say what is the spread on that instrument? What's that referring to? Anybody know? Right. Okay. A couple of you are not familiar with that. Okay. Well, it wouldn't be the broker fee or commission. Let me show you real quick what that is. It's the difference. It's the difference between the bid and the ask. Yeah. Real quick. So what you want to do is open up your chart trader panel, or you can see this in OT, and you look at the difference between the bid and the ask. Now normally in high volatility markets, after markets open and there's a lot of liquidity, this gets down to, it should be one tick. So you're paying the difference between the bid and the ask when you get in at the market, and the cost of entry is normally 1 tick. Now, if you're trading after hours and you see that, or pre-market like this, and you see the spread is 2, 3, 4 ticks or more, it's probably something you want to avoid, because you're paying an extra 3 ticks plus commission to get in and out. So you got to have a pretty good move to cover that, right? That's just a heads up. Now, normally when markets are open and, from 6:30 through the rest of the morning till the close, normally not an issue. The other issue to consider here is the liquidity. If you see 1 bid, 2 ask, 3 bid, 4 ask, if you're going to try to put any kind of size on that, more than 2, or 3, you're going to get, in addition to the spread cost plus commission, you're going to get perhaps some slippage. Slippage is the fact that there's not much liquidity. You're trying to get in and out of the trade, and you're getting filled at a couple of ticks. So just be careful if you're going to trade that, after hours like tonight, European session, or in the pre-market here before this 6:30. It is tradable. That's the 2 things to check: what the spread is and what the liquidity looks like. Okay. All right, so we're clear on that. All right, so in this short here, depending on where you got in, how you boxed it in, where you got filled, you got that short here in the pre-market session. Came back up here, didn't quite get back to the mid-band. You could have used your line or ray tool, any manner of tools to get in. You could have boxed it in here when it started to roll over here. Either way, you would have been filled on probably, this bar right here, short. And then you had a nice precipitous drop out of that box or that line there in the pre-market. Let's do some numbers real quick. This one you could have got filled, say 92, 91, got down here to 82. That's 10. Let's call it 9 times 4. 35 tick trade. Times $5 a tick, 100 and almost 200 times 2. Say if you put 2 on, $400. Real quick, let's look at this one. Let's say you got in here, I don't know, let's call it 83 for a round number on that bar. And I don't know, maybe you had a trailing stop and you got out here at 74-ish. So it's 74 to 83, 9 times 4, 36. Yeah, so 36, $5, that's 350 to 400 bucks. What I'm trying to show here is that before the market even opened, if you're looking for opportunities, and we're going to look at a crude oil chart too, because I know you're watching that at 6 in the morning when the pit opens with Gary. But you could pick off a trade or two and be up a couple $100 going into the open, which can take any kind of little bit of pressure off there to make some money, knowing that you're kind of up already before the market even opens. So what is our let me ask this question for all of you that like to trade here. When you go into a trading session in the morning, whether it's early crude oil market open, maybe you come in later, maybe come in at 7 Pacific. What are your thoughts? What are you thinking? How you prepare yourself mentally to go after and tackle the morning of trading? What's going through your heads collectively here as a team? Just type in some thoughts. Something like, I'd like to make a ton of money today. I'm going to really keep an eye and trying to nail as many trades as I can today. I hope the market's got a lot of movement because I want to make a ton of dough. What do you think? I'll give you a couple seconds to think about that, and then I'll share what my thoughts are. Peter W. I'd like to be able to follow Gary and Charles better. Peter, I don't know about that one. Here you go. Okay. Dennis, something real simple. I like this. Looking to just make about 10 ticks. Good. You didn't even put a market in there. That's perfectly fine. Oh, this is some good answers. Let me share this with the team. This is actually some very good answers. David D, I just try to stay out of chop and keep the donations low. Looking to be open to shorts and longs. Take any bias out of my head. MG, hey, good to see you. I didn't see you come in. I like that. In fact, we're going to talk about that topic in just a minute here. GW feels a little pressure to make some money. Okay. Check to see if the market's trending up or down or sideways, says Brian. Looking to be green. Risking 1 to 3% of capital. There, I like that answer, Dennis. Now, everybody in here tonight had some very good answers. All those are very good answers. But there's one word that I did not see in any of the answers, and it's the key word that I was actually looking for, which would be what? One word. Because I'll tell you what, this one word is all I'm thinking about when I get ready to trade in the morning. This is like my purpose of trading is this one word. Maurizio got it. Got a lot of good answers coming in. Dennis, GW, PW. Goal. I want to get to my goal. That's the goal, right? So let's say hypothetically, you want to get your goal. So I mean, those are all good answers, and it's really a twofold answer. In all fairness to everybody, it's really a twofold answer. I want to achieve my goal for the day, which is how much money I would like to make for the day, and I want to do it with as little risk as possible. I know it's a long-winded answer, and I want to keep my losses low. Now, it's quite possible that a couple of huge monster trades come along early in the morning like it did today. Past couple of days, we've had just huge monster moves. Excuse me, and I can hit my goal in less than an hour, sometimes even a half an hour. And then you can decide whether you want to cut back a little bit and continue to trade. But it is possible. It is possible to do it. And that is the goal. The goal is to hit your profit goal for the day. So let's all be focused on that when we look at our trading tomorrow, right? We're trying to hit a goal. We all should have a goal. I haven't talked about that in a long time. I'm not going to spend a lot of time on that. We all should have profit goals and maximum stop outs. I don't change my goal very often, GW. I have a set goal, and that's what I go for every day. And when I get at it or close it or over it, like today I went over it about 40-50%, I'm pretty happy, and then I stop trading. So like for instance, if you hear me get quiet in the room, it's probably because I hit the goal and I'm just kind of watching the markets. So what I'm trying to show you here in this little pre-market example on NASDAQ is the fact that, let's do a hypothetical. Let's say your goal was fairly modest, and you wanted to make $500 in a day or a session, and you come in here in the pre-market and you peel off a couple of contracts on a short, another short, and you're up maybe say $700-800 by the time the open comes, and your profit goal was 500 for the day. Do you need to continue to trade the rest of the morning? Yes or no? Profit goal was 500 or so. Max stop out loss for your size of your account, excuse me. I don't know, hypothetically $300. Max stop out loss, profit goal. You nail a couple of early trades here. Market's getting ready to open. You're up almost $800. It's hard to resist. Yeah, you should stop trading. Okay, that's what I'm trying to say. That's the whole point of this thing, is that a lot of your success, and I've been doing this over 20 years, and I've been up and down and all over the place. And when I started to finally get consistent is when I obeyed the rules of risk management and money management, and I set strong goals and I set strong stop losses, and I got very heavily into proper entries and targets and what have you. And it's when that money management came together that I really turned the corner. Because before that, I would go into sessions and I would be, I don't want to say loosey-goosey, but it'd be kind of like, okay, well, whatever the market's going to give me today, I'll take it. And, you can't, if you're going to really be in this trading business for a long haul, you've got to have more organization and treat it like a real legitimate business with profit goals and targets and stop losses and all manner of that kind of thing, okay? Turn off the computer and go enjoy the day. That's the whole point, Dennis. All right, now here we are at 6:30, 6:31. So this is the first minute of trading here. And we see that there is a region box forming right around the mid-band on NASDAQ. Question for the team, and this is a fairly simple one. If and when you were to box in a box like this at 6:31 on an equity, doesn't matter what it is, could be YM, could be the Russell, could be ES, anything. What would your bias be on this box? By the way, I'm going to give you a little help. That's a trick question. All right, I'm going to give you a little bit of help without giving it away. That is a trick question. What would your bias be at 6:31 at the equity market open on an equity that was boxed in right at the midband, just like that? I'm only going to give you like 5 seconds. Everybody should know this right off the top of your head. This is important. What are our rules at the open and news events and high energy times? What are our rules? Remember, this is a trick question. I'm trying to help you here. Time's up. All right. Now, most of you, I'd say a fair amount of you said your bias is down. And I can understand that because you know, the background is red. We're stair-stepping down. We're clearly in a downtrend. You just came off of two nice, beautiful shorts here. You bottomed out around 72-ish. You're back here at the mid-band. And our natural expectation, in a normal course of a morning, excuse me, hold on a second, take a sip of tea. Sorry about that. Would be to have trend continuation, and this market should theoretically just head right back on down, yes? That's our natural inclination. Now, what overrides that is the fact, yeah, GW is saying that his no bias for 45 minutes. You could go as far as 45 minutes after 6:30. I think once you get beyond 7 a.m. Pacific, you know, 30, 45 minutes, that's kind of the tail end of taking both sides of trades. But the correct answer, in my opinion, is no bias, simply because of the time the box is being drawn. If this was any other time later in the day, like if you're trend trading later in the morning or into the close, and you see a retracement to the midband, the rules are short only, and we know that's because it could go higher up into here before it rolls. Yes, and in a very powerful steep downtrend, we don't want to get sucked into a long when we don't want it. So that would normally be the rule. The exception is at the open, high energy times, big news events, you know, normally around 7. So if you didn't have a bias, and most of you didn't, you actually got filled long on this bar right here. One of these bars, depending on how you drew this box, using Object Trader, one of these bars filled you long. Now let me ask a question here for the team, just to get a quick poll. Right here, one of these bars, depending on how you drew the box, David D. Let me blow this up. Maybe you can't, it's hard to probably see this. You're filled long right here. Probably that one or this one. See these bars right here? You're filled long out of the box, right there. See it, David D? How many contracts do each of you put on? Just type in a number. When you take a trade early in the morning, how many contracts are you trading right now? 1, 2, 5, 10, 20? On a typical trade in the morning, how many do you put on? Interesting. A lot of 2s. A lot of 2s. Good. Good. A couple of 3s, some 5s. Chart's not frozen. Wait a minute. Hold on. Hold on. Check, check, check. Moving arrow around. Can you see my arrow? Moving arrow around. Arrow moving. Now moving? Oh, that's why you're asking where. Okay, I'm sorry. My screen might have been frozen. Okay, so if you drew, here was the box, right? Here's 631, open in the market. We draw our box. We're looking for an entry, no bias. We don't get a breakdown, no continuation. Get filled on one of these bars right here, and we're long. Now, the way we like to manage our long trades, if you have two or more, is we try to peel off some, what we call, take some scalper coin at a swing, or when we get a pop between anywhere from 6 to 10 ticks. So you're looking up here to peel some scalper coin out when it pops up. That's your initial pop, right? Then we take our initial stop, which is normally 12 ticks below our entry. Let's say your initial stop was here. And we want to take that at least 2 ticks behind where we were filled. That way, in the event something funky happens, it reverses and craters through us, we only lose 2 ticks from our entry. We made 8 or 10 in here. We still have a winner chicken dinner trade, right? Everybody see that? I hope everybody's doing that. You can set out the Object Trader. I think Gary has shown this. We've talked about this for 2 years now since Object Trader came out. That's kind of our mode of operandi, if you will. That's how we do it. If you're taking at least 2, you peel 1 at the scalper target, and then you start to trail. Now, early in the morning, sometimes you can get these huge runs. So you have to be careful, and there's a little bit of judgment involved with that second target. Some people put it out 20 ticks, 30, 40 ticks in anticipation that you're going to get a run. In the room, you might hear something when on a big move like, go ahead and drag your targets out of the way and just let this run. Now, why are we saying that? Well, because here's what could happen. Let's say you put another target up here. Let's say this one was, I don't know, 10, and then you had another one up here at 15 or 20. I'm just using hypotheticals here. And let's see what she has. So you got 1, there's your other one right there. Okay, comes up, plows right through it, and goes all the way up here. So let's look at the mechanics of this trade real quick. Let's say you got filled on this bar here at 79.50. I don't know, let's call it 80 just for a round number, okay? Right in here, 79.50, 80, right in here. So what would 10 ticks be? 10 ticks is 2.5 plus 79, be 82, 82. So here's your first. If it was 10 ticks, you're getting peeled off right the circle where I said, right here. If you had 20, then your second one is up here. Right? Well, look, it ran all the way up here to 97. So in actuality, the move was from 79.80 all the way almost to 98, call it 97. How much is that? 17 times 4 is 68, almost 70 ticks. Now, here's the thing I want everybody to do, if you can, okay, is each of these instruments moves differently than the other ones, okay? You know, you should, whatever instrument you like to trade, I would study the movement and find out what the average move is. Okay, if the average move that you find in the morning is around 30 ticks, you're going to probably want to put your targets out around 30 ticks. Now, if it starts to get up to 30 ticks and you got a real runner on your hands and you want to just sort of let her go, that's where you take these targets and you start to move them up a little bit as the market continues to move in your favor. And the way you protect yourself is you just move your stops, the trailing stops, like this. So essentially what you're doing is you're kind of boxing it in, right? Now, Object Trader can do that for you. There's settings in there that allow you to do it, but that's essentially what you're doing, right? You're letting the market move in your favor. So you had your initial runner target, right? It's taking it out and you're tracking it up. Now, why do we say 2 levels of stops in the room? Why are there 2 levels of stops in the room? A lot of times you'll hear tight and loose stops. What is that referring to? Don't you just have one stop? Wouldn't there just be one stop for a trade? Why do we have different places to put stops? Anybody? Why do we do that? I don't know if anybody even pays attention to it, but why would we do that? Is there any benefit to doing it that way? Allow the market some wiggle room. So your broker doesn't know. I like that, Dennis. That's a good one. Well, you have to imagine with all the folks that we have all over the world trading with us in the live room and using our tools to trade, there's different trading styles. There's a style that has more of sort of a scalper mentality where you have very tight stops and then you look for reversals to get back in. So a tight stop approach might be to have your stop here, and then when it let me get this silly thing off of here. Stand by 1 second, please. There we go. Let's say your targets are all taken out of the way, comes back, and say you get a retracement, and then that trader would look for a retracement. Now, a trader who allows more wiggle room, so to speak, can have what we call a little looser stop policy, allow the market to do its retraces because they prefer not to get in and out, and just when it run, just let it run. You have to develop your own style. That's what everybody does with Viper. You know, we try to show all kinds of different styles. You have to find out what works best for your trading personality. If you prefer to get in and have a fixed target here, okay, and then you're and you got taken out, and then you're looking for a retrace, then you jump back in when it does its retrace. You jump back in and you ride that up, and you do that all the way up, right, in and out. And you would prefer the tighter stops. I do a little bit of both, actually, to be honest with you. When I throw out targets, I say, okay, next target's 92.25. Well, what's happening from the multiples that I got in with down here is I'm peeling some on the way up when it's hitting those swings, right? And I'm keeping the loose stop. I'm generally using the loose stop. I'm using that loose stop. Okay, I'm not doing the tighter stops. I'm only calling the tighter ones for those who like to get in and out. But I'm peeling multiples. Typically early in the morning I'll put 20 contracts on or more. And so I'm peeling a few as it goes up. And then as it goes up, I reduce the stop. I reduce the stop until whatever is left on the final gasp, so to speak. And then I close the rest of it out and look for re-entry. So it's kind of a mix of both. And so you should, each of you tonight, when you trade, and you can do this in sim too, right? Go ahead, put 2 or 3 on, peel that first popper, right? Go ahead, maybe take another one off at a swing, and then now you have at least one runner. I mean, that's the goal. One of the goals in order for you to capitalize on these large moves and put good coin in your trading account is that you got to really take advantage of these runners, lock that money down early, so that you can reduce your exposure. Leverage is the key. You've heard me say that a million times. Leverage is where the money's been made. It's going to be tough to make, a decent amount of money in trading these futures markets when you're only doing one contract. So it's good to do one when you learn. Okay, don't get me wrong when I'm saying this. When you learn, put 1 or 2 on and learn the entries and learn trade management. When you get a little bit more experienced, and you're pretty good at the money management side of things, you can go ahead and leverage up higher. All right? Okay, good. All right, well, let's play the rest of this out, and let's see what happens with this trade and how she ends. And then we'll go on to look at another trade. Ready? All right, let's do a hypothetical here. Here was our targets. Let's just say that the traders who were trading this move their targets out of the way to let it do its thing, and that you were following the stops up like this. You either got stopped out or you got back in, and your stops are right here. So the close of this bar, one of these bars here, probably got you out, and now you're looking for re-entry, right? So let me pause for a second. If you got stopped out somewhere in here on that long trade, whether it was broken into 2 or was one continuous trade, where might we be looking at for potential entry? By the way, while you're getting ready to answer that, I'll give you 10 seconds. I'll just continue to talk a little bit while you're answering that. So we're looking for re-entry. We're looking for the market to come back somewhere, to do something. Ideally, most of us, I know, we like the mid-band region boxes. So that's what we're kind of, whatever. Where are you looking for this area to pull back to? By the way, while you're kind of sorting that out, let's do a quick assessment of this trade. Let's say you got in here, we said, excuse me, 79.50. Your first target was 10 ticks, so it got taken out right in here somewhere. So there's 10. And then you had a runner, and the runner, say you got stopped out at 94. So what was our entry? 79.50 is 2 plus 14 times 4 times 4 is 56. I don't know, 60. Let's call it just for a round number. 60 plus this, 10. So you're right at 350. How many of you would continue to trade? How many of you would be done? Let's say all told you're in there between $350 and $400, depending on how, where your actual entries, where your targets, where your stops were, where you actually, however you manage the trade. It's somewhere in the 350 to 400. And it's 6:37 in the morning. You've been in and out of the market for about 10 minutes. Let's say you didn't take any of these pre-market trades. None of this. You didn't take any of this. You just started looking right around here when the market opened. You did the box, you got filled, you managed it, and you're up almost 400 bucks. How many of you would continue to trade? How many of you would be done? Quite a few. Good. Now, there's nothing wrong with continuing, okay? If you had, say you had more on here, maybe you had 3 or 4 contracts and your gain was closer to 1,000. What I'm trying to express to you is that, you can go ahead and take another trade if you want. This could be one and done here. If your goal is not met, or you would like to entertain taking another trade, maybe you cut back your risk. So normally you put 4 on, maybe you put 1 or 2. If you put 2 on, maybe you just put 1 on the next one until you get closer to your goal, or you're over your goal, or you're happy. Because you're less than 10 minutes into the market here, but these moves can happen to give it to you. That's what I'm trying to say. All right, most of you said the mid-band on the retrace. The mid-band is down here right around 91. Okay, we're coming down towards it. Where are we at right now with these yellow bars? Here's your retrace right here, sitting right on it. By the way, I know there's quite a few new folks in here, and I'm just going to say this so everybody's clear. So when we say box that in, everybody knows what we're saying when we say that, right? So see we have whole webinars dedicated to this whole issue of boxing in. Good box, bad box. I did a 2-part series like a week or 2 ago on that very topic. If you haven't seen it, log into the subscriber area, type in the word box, and go back about 2 weeks, maybe it's 3 weeks. I did a whole 2-part series on the whole topic of what is a good box, what is a bad box, where are they positioned, and how do you take them. It's really important everybody understands that, because this is an integral part of our whole trading approach. So if you're not if you're not in tune with this whole notion of using the object trader tool and using region boxes, then it's going to be a lot more challenging for you to take these trades, especially in the live room. And we're calling out, box that in. All right, good. Most of you got that correct. We're looking for an entry somewhere down in here. Now, is there a bias on this box? Yes or no? And if you say yes, what is it? Is there a bias on this box, long or short? Yes or no. You can tell L or S, long or short, or yes or no. And if it is, then you have to say long or short. Bias on this box right here. I'm going to give you 5 seconds. You shouldn't even have to think about this. You should just hit a button on your key board. Long or short, yes or no. What are you going to do? 6:37 a.m. NASDAQ market, June contract. What are you going to do? Time's almost up. Four seconds. You got the box. You wanted it at the mid-band. Everybody typed in mid-band. What you going to do? You got your mid-band. Time's almost up. All right, time's up. Now, most of you said the bias was long. However, there are a few of you that said no bias. And what time of morning is this? What time of morning is this? When we first started the webinar and we looked at this trade right here, and we had that same exact question, probably maybe 15 minutes ago. We drew this box right here, and we asked that exact same question on this box, remember? And when we answered that question, what did we say? Anybody remember? I'm just going to help you out here if you maybe, because quite a few came in late, so I'm going to help you out. Some of you might have missed that, in all fairness to you guys and gals in here tonight. There was no bias on this box because it's the open. The market can go either way. We have to remove our expectations in the first half an hour to 45 minutes. These markets can go up and down, a roller coaster, V bottom, V tops. They're going to shoot all over the place. We have to be prepared to capitalize on those moves. So if you have a bias to the long side, look at what happened here. What happened right there? What is this? Those of you that said long only, anticipating a trend continuation at 6:37 in the mornings, the market's only been open 7 minutes. What happened right here? What is this? It's a beautiful short where it came all the way back down to here. Came all the way back down to here where it broke out. All the way back down. 60 ticks straight back down. You missed it. You missed it. You longies missed it. Now look, there's nothing wrong with that. Look, not all mornings work out just like this, okay? Many times it does, okay? Many times it does, but sometimes it doesn't. Sometimes, you can get sucked into a little bit of a head fake short here, and then the way you deal with that is that you watch where it comes back up to. What I'm saying is, let's suppose you didn't get all the nice follow through on the 60 tick drop. Well, maybe it comes all the way down to here, somewhere, just hypothetically, then it comes back up to close to your entry and rolls over. Here's the bottom of your box. You got filled on one of these bars short right here, right in here somewhere. Comes back up and checks it, and then rolls over. That's why we say things like, that's why you hear something like, okay, it's dropped 10 ticks. Take the scalper coin, tighten your stop. So here again, what are we saying? Just to help. I know repetition helps to remember this sometimes, but what we're saying in this hypothetical scenario here is that you got to your scalper target. In this case here, it blew right through it, of course, right? And then you're doing your runner with your stops. Okay, we'll talk about that in a second. But in the event that it bounced, your initial 12-tick stop was somewhere up here, and you want to use Object Trader or manually get it down close to where you got in within a couple of 3 ticks of your fill. So if it does come back up and check it, you don't take a bite on it if it goes back in the box. And that happens sometimes. That happens sometimes, and you have to be prepared for that. It's not a big deal. If you did the 6, 8, 10 scalper target with the 2, 3 tick back, you're still good, right? In this case here, you didn't have to worry too much about it because now you're just trailing the stop on now. However you trail it. I don't know. So you get taken out on that bar right there. Right in here. So the actual trade itself would have been from this bar right here, close of this bar right here. Let me show it so it's clear. You boxed it in like I'd shown. You would have been filled short on that box right there outside the box. And then your trail stop, you got your scalper coin right there at 8 or 10, and then you got taken out on the runner right there. Came all the way back to 80, where you got in over here almost, huh? See that? 79.50 right here where you got in on the long, came all right back down to it. That happens a lot in the morning. That happens a lot, especially when you get a lot of volatility. You got a lot of news. Crude oil days pushed, on Wednesday, pushed the markets, equities all over the place. So how much money did this one make? Let's see. The first contract you got 10, and the second one you got. Let's just do it real quick here. No, you got filled at 90-ish, and you got out at 80. So 10 times 4, 40 ticks. 200 on the second one, and 250 roughly. 250 roughly on that one. So what did we say you made on this one? This was 10 plus 60. Wasn't this 350, 400 over here on the long trade? 250 plus or minus over here. So now you're up 750. How many are you done now? You're at 645. You've been trading for about 15, 20. Well, if you were in the pre-market, you might have been watching about a half an hour. About a half an hour, you've had two trades. You had a long that worked out, and you had a short that worked out. And let's say, depending on your fills and how you managed it, you're somewhere up between 5 and 7, 800. Two trades. Done and happy. Okay, Carl G's. Brian, the size of the scalp, that's Brian's question. Some zeros are missing at the end. Hey, listen, here's what I want to do. I want to say something about this, okay? In the room, various places, okay, sometimes you hear a lot of numbers get bantered around, 1,000 this, 2,000 that, whatever. And, on one hand, I think that I'd like to say this. I hope that you find the numbers that are talked about in the room to be in a positive, putting a positive light on them, somewhat inspirational if you're not hitting those numbers. Consistency is the key. That's true, GW. Consistency is the key. And, what I'm trying to say is this, is don't feel inadequate or that you have issues because you're not making 1,000 or 2,000 a day, okay? There are lots of traders that have been with us for 7, 8 years, and they come in and they make a few $100 in the morning and they're done. And they're perfectly happy. They've been doing that for years, and you can either make a living off of it or you can sock some extra money away if you have other things that you do. So, I mean, that's the way to look at it. It's a personal thing. Everybody, I can just pick some different names. Everybody's different goals in here are going to be different from everybody else, and mine are different than Gary's, and Gary's are different than everybody in here. So it's a very personal thing. You have to embrace the instrument you trade. Find the proper entries is the key, and then manage the money as you see fit in relation to your situation and your trading account. That's the bottom line. And don't worry about what everybody else is making. Yeah, I mean, I see some comments in here. If you go for a modest $100 a day, eventually you could leverage up, put some more contracts on it, and it turns into 400 or 500 or even 1,000 a day. But the key to success there is not to focus on the money in the beginning. Everybody gets so wrapped up. How much money can I make? How much money am I going to make? I like to make a ton of money. Well, that's great, but you missed the entry. And you didn't manage your stops and targets properly, and maybe you had a trade that turned into a loss. You had a hope trade where you let the stop go against you, and next thing you're upside down. So in that case, the money doesn't make any difference in the end, right? If you focus on the fundamentals, the good entries in money management, that's where you're going to make the money long term. Brian says this, a little bit of feedback here. My problem is trying to figure out how many targets to go for, one scalp and one runner. That is not necessarily two contracts. You can put several on both, a scalper and a runner. Yeah, that's true, Brian. Yes, absolutely. I would caution everybody who's going through that issue, to just start with the one and the one, do the two. And you know what? And maybe the simplest thing to do is just go for the scalper and then just try to manage a runner. Okay? Go for the scalper and just try to manage a runner. That's the simplest way to do it, because the whole principle of leverage is that once you have the fundamentals down of the entries in the target and stop management, then you leverage up and you can put 3, 4, 5 multiples on. But if you can't get the 1 and 1 to work, obviously you're not going to want to ramp up to 3 or 5 or more. Okay, Brian? Does that make sense? All right, good. Yeah, that's generally the rule. Brian asking here again. So after you get this, he's asked, I think some of you might have asked this question or are considering it, is is, depending on the instrument you trade, look at what the typical pop is when it makes that initial move, right? So in this case right here, NASDAQ typically, when it pops out of a region box, it's not unusual to see 6, 8, 10 ticks. So it's your call. You can put it 6, 8, or 10, or 12, whatever your call is. I like 10. Sometimes I'll put it at 8. If it's struggling at a swing, I'll drag it down and let it fill. Okay? That's the initial, that's the scalper pop that we talk about all the time. There's your scalper pop. And we usually give a level out when it hits it, right? And then that's where you take your initial stop. Say you got filled on this bar long, right? Your initial stop is 12 ticks below there. I'm not going to do all the math. It's probably down in here somewhere. That's your initial, right? Popped up here, you take your initial, 2, 3, 4 ticks behind your entry, so that if it does reverse and comes back here and goes back in this box, which sometimes it does, you still made some money. So let's say it's hit its head here and just decides to come right back in the box. Well, you don't want it to come all the way down here and get your 12 tick stop, right? In fact, you might be looking to reverse. So if you came up here, you're actually stopped out, and we say it's gone back in the box, right? So when you hear that, that's what we're saying. We're saying, okay, it's stopped out and it's going back in the box, which means that it's back in here. And once again, we can be prepared to trade either way, because we know it could bounce and head up like this, or it could take the bottom out and head down like that and continue the downtrend, right? Everybody following me there? Any questions on that? Everybody understands what I'm saying there, right? As far as that pop and getting the initial stop up close to your entry. Everybody following that? Big aha moment for you, Brian? Okay, good. Any other questions on that? Well, if you're trying to put, I'm getting some comments here that they try to go for 12 ticks on the scalp pop. If you're finding in the instrument you're trading that the 12 is too far, hold on one second, please. So that kind of goes without saying that if your scalper targets have been 12 and it's missing them, then you've got to drag your lighten that up a little bit and make it 6 or 8, so at least fills. You want that to fill, and you got to get and then set object trader or manually do it to get that stop up tight. Listen, I got to move on. We've burned almost a whole hour on this. I know it took a lot of time. I hope this was really helpful. Let's get on to another chart. I've got to move on here. I'm going to run out of time and not even get to another chart, so hang tight. Excuse me. Hold on one second, please. Alrighty. Let's see what else I can get done over here. Hold on. Pausing the screen for just a second. Let's see if I can get a crude oil chart down here. I know several of you asked for NASDAQ and crude. Let's see if I can get crude in here real quick before we run out of time. I was going to try to get YM in here too. By the way, any Russell traders in here? Anybody trade the Russell? Just a quick poll. Anybody trade the Russell? No. Okay. All right, not too many Russells in here. That's all right. Well, we'll go to crude then, okay? Stand by. Trying to find a 6 o'clock open for crude here. Okay, this is the other day. Let me see if I can find out what day this was. This was like end of April, so this is a few weeks ago. I'm trying to find a setup here for you. It's 6 o'clock. All right, let's do 6 o'clock on this particular day, and I'm going to ask you what you think is going on here. Ready? Here, I'll put it right at 6, just a few minutes after 6. Ready? Here we go. Yeah, Maribel, my apologies. I missed your question there. We have quite a few new people and some folks just kind of visiting and on a trial and what have you. All the times down here are Pacific time. I'm here in California, so this is all Pacific. Midnight Pacific on this day would have been right here. Midnight Pacific would have been right there. So this is the European session here, coming into the pit open for crude. Hey, by the way, I'm just gonna offer for all the new folks that are coming in, you know, instrument selection. In addition to learning all the entry techniques, the arbitrator tool, money management, all the things we discussed, instrument selection is going to be critical to your success. You've got to find an instrument that speaks to your trading style and risk tolerance. Most of you know, of course, that the YM and the NASDAQ and NQ are $5 a tick. The Russell TF and oil are $10 a tick. For each tick of movement, you could say that the Russell and crude oil are twice the risk because of that very issue. So, you know, in some senses that can be a good thing. In terms, if you're on the right side of the trade, you stand to make for an equivalent tick move, 20, 30, 40 ticks, whatever, you can make twice the money for the same amount of contracts, right? 5 versus 10. What's the flip side of that, though? What's the flip side of trading a $10 instrument versus a 5? What's the other side if you could stand to make twice as much money on the upside if you're right per tick, per contract, so to speak, right? You can lose twice as much. There you go. Exactly. The risk is twice as much. So that's the thing that's challenging for a lot of traders is that, you know, and I don't, it's just in our nature, I think. I don't know why this is, but we tend to always think of the upside, right? We tend to be more positive. Look how much money we could make. And we tend to sort of gloss over sometimes how much money we can lose. And so that being said, you know, just to be clear about this, if you're going to trade crude oil or the Russell, you have to be prepared. You know, you got to have a little bit more money in your trading account to withstand losses if you're going to take hits. Everybody understand that? You know, if you're learning and you're just in the early stages and you're just putting 1 or 2 contract and you have sort of a, you know, sort of a very, you know, mid-range kind of trading account, you know, I'll just throw out some numbers. You know, if you're under 10K, you know, if you're at 5 or 10K level on your trading account, somewhere in that area, you probably want to stick with the $5 instruments, really. Because on crude oil, it wouldn't take many hits to go through $1,000. And that'd be like 10% or more of your trading account. We all know we should never risk more than 3 to 3.5% of our trading account on any given day, right? So you can do the math. Okay, so anyway, saying that, when we come into the 6 a.m. pit open on this particular day, what are we thinking about this market? What does this look like? What are your observations of it? Here's 6 o'clock right here. Let me put a vertical line right here so you can everybody get sort of tuned in. Just type in your thoughts. What do you know, tomorrow morning you wake up, you're in the room with Gary, and the market looks like this on crude. What's your approach going to be? What are you thinking when you see this? Thoughts? Anyone? $6 a.m. on crude. Tomorrow morning it looks like this. You come in the room, Gary opens the room, you got a chart on your screen there, he's got a chart up, you're listening to comments and what have you. All right, I'm seeing some feedback, uptrend, chop, looking for support and resistance, range bound. Yeah, now, so let me share with you my observation if I was to see this, you know, at this particular time. You could make the case that you do have a series of slightly higher highs and higher lows. However, you could also make the case that it's been punctuated with small sort of range-bound movement. And so that's just sort of a nice way of saying, you know, it's going up, but for much of it, it's kind of going sideways, with the exception of these little spurts up right here, right? How many of you like to trade ranges? How many of you trade ranges? How many don't? How many of you do not like ranges? Okay, I'm kind of showing you my interpretation of what is going on here. Kind of a mixed bag there. Messy patterns, Carl's G. No, no, no. Yes, they're comfortable. No range. Okay. So here's the thing. You know, if you're making the case that it is in an uptrend and you recognize the fact that there are these sort of ranges, and with the exception of these little sort of bursts out to the upside, then most of you had typed in earlier when I asked the question, you said, I'm waiting for a pullback. Because right here at the open, you could observe the fact that it's taken out this swing and it's pushing up to these fresh swing highs. So our number one rule of thumb is we don't take thrust moves. We're not buyers of thrust moves, whether it's up or down. We're not buying or selling the thrust move. We have to wait for a pullback into support or resistance to take the trade. So most of you type that in, and that's the correct answer on your approach and your vision for this. So when you wake up tomorrow morning and you look at charts, no matter when you come in to look at them, whether it's early or later, that should be our first observation. Where is the market you're looking at relative to where it's been? And if you're observing the fact that it's putting in fresh highs or fresh lows in a thrusting type move, we know we have to stand down and we have to wait, right? In the case of the uptrend, it's got to pull back down into here somewhere. And we'll look for some consolidation pattern or some kind of bounce to get long. Everybody see that? I want that to be clear. Okay, when we first look at markets early in the morning like that, we have to observe what they're doing. Now, let me advance the chart, and I'll show you what happened. And then everybody in here can make a call. Ready? Here we go. Okay, here you're about maybe 30, 40 minutes into trading. You know, you came back here, almost checked the mid-band, you got a bounce, went up, took out the swing by just a couple of 4 or 5 ticks right in here, this swing right here. And now it's kind of hanging at the mid-band. What do we think about this? This will be the last question. This is the last trade we're going to look at, and then I'm going to wrap up, okay? I know I'm running over tonight. It's all right. We got a late start. What do we think about this? I mean, in all fairness, you'd have to really kind of box the whole thing up, wouldn't you? That box would be 19, looks like 11, 12, 14 ticks, maybe. If you engulfed all the box. No bias, too big, messy box, not clean, looking for longs. We got a whole mix of answers here. Now, in regards to the bias issue, as it's related to this particular box, first of all, I would agree with you. In fact, as the box started to form, you could technically make the case that the box was more like this. You're coming up on 7 o'clock. Crude, you know, you have to adjust crude back a little bit, because when we said the equities were 6:30 to 45 minutes, you know, half an hour, 45 minutes, that takes you out to about 7:15. By the time you get out to 6:50, almost 7, crude's been trading for almost an hour. All right. So 2 things in observation in regards to this box. Given what crude is doing here, how range bound and choppy and sideways it is, first of all, I would agree, those of you who commented that this box is messy and too large, I would agree with that. On the other hand, if you drew it before this little spike down and it looked like that, you're right on the cusp of acceptability. And just to be safe, because the box is so large. It's not, sort of tight and clean and well-defined at the mid-band like we'd like. You probably want to be err on the safe side and err to the long side on this particular box. Only due to the fact that you're almost an hour into the trading session. If this painted closer back over here, let's say hypothetically here, let's do a quick sort of hypothetical, which didn't quite happen, but let's say that this little bip down here, right here, sort of settled in closer to here, with the tight range, and you're only about 15, 20 minutes into trading, yeah, you would have no bias, and it came up and you got a nice long trade here. As it happened, it didn't quite get there, so that's all hypothetical. But now you're an hour into it. It's really messy. It's kind of at the bottom of that trading range. I would try to box it a little tighter and just bias it to the upside. We'll see what happens. Okay, pops up. Get a little bit of a long trade there. Takes out the top of that range. Kind of keeping with the patterns it did in the pre-market session here. See that? See how it goes sideways and then up, sideways and then up, sideways, back to support, then up. So you did get a trade there. Depending on how you managed it, didn't give you a whole lot. So this is a case here where, let's suppose that you have two charts up, maybe three. You're looking at, say, NASDAQ, YM, or Russell, NASI, and crude. I wouldn't go any more than two or three at the most. For depending on what stage in development you're at there, I would never put four charts up. If you're still kind of in the early stages of picking this up and learning and what have you, four is way too many. You should really try to keep it to two. So, pick the two that you like and try to get fine-tuned in on those. And here's the thing with crude, plus the fact that it's $10 a tick. Try trading crude and sim. If you get to a point where your success ratio is very high, 67, 70, 80%, in other words, you're picking the entries really well, and you're managing the trade and making money, then and only then consider to go live on it. If you try to trade it in sim and it smacks you around a little bit, I would strongly urge you that this might be an instrument you might not want to, trade live money on until you're just absolutely certain that you can do it and be consistent at it. Had another pullback here just on the mid-band, and then this particular day, well, this would have been closer to 8 o'clock, so you're almost 2 hours into the trading. We're closing the room up around here, but it did wind up getting a really tremendous run there. All right, I'm going to go ahead and wrap up. Let me stop the recorder.